again be joined by Ed Martin, President and CEO of Nalcor, to release Ziff Energy's independent review of the natural gas options. Ziff Energy is a Calgary-based company, and you'll see in the report there's a profile of of who they are and what they do. This report came about as a result of issues raised in the public over the last number of months as to us not having thoroughly explored the natural gas options. As you'll hear from Ed, the options were screened out at decision gate 2, but we felt that having regard to the issues raised, that they were valid issues, and the prudent step would be to have them reviewed by an independent expert. The natural gas options broke down into a liquefied natural gas option and also the transportation of gas from the Grand Peaks via pipeline. So Ziff Energy was commissioned to complete an independent assessment, and they were, I think it needs to be made clear, they've been hired by the by government and not by Nalcor. They were commissioned to complete an independent assessment on the availability and feasibility of natural gas as an alternative for electricity generation on the island of Newfoundland and to replace the current oil-fired Holyrood Thermal Generating Station. Both options raised, or the issues raised by the critics, were certainly valid issues and ones that have been approached on a very scientific basis. This is an issue of, can this work? And that's what Ziff was asked to look at. So we look at two scenarios. The first scenario involving natural gas being supplied to the island grid from the Grand Banks via 300 to 600 kilometer pipeline, depending on the route chosen, result of icebergs. And the second scenario involves importing liquefied natural gas, or LNG. In the first scenario, excuse me, Ziff Energy acknowledges, the first scenario being the pipeline option, that natural gas is physically available in Newfoundland and Labrador's offshore, I think as we're all aware. However, it's not available on commercially viable terms for power generation. Current surplus gas is either is injected for use in oil recovery or stored for later use in oil recovery or for future monetization. Oil and gas companies operating in the province have evaluated this option and have yet to identify an economic project. The price needed to make development viable, we're told, will be in the range of $10 to $12 per million BTU, or 1,000 cubic feet. Prices are currently up in natural gas in the United States at around $3.70 Henry Hub, up from the $2 to $2.50 range. Experts that we have consulted with predict that natural gas will rise to $6 in the next decade. The current low market price is a deterrent to development, and the province cannot compel operators to produce and sell gas to the island power generation market, nor can we mandate a price that the operators must accept for their gas. In terms of cost, even if the Grand Banks natural gas, so we're saying, one, is not, we can't do it, but secondly, even if we could, the conclusion is that Grand Banks gas is not commercially viable in terms of being prohibitively priced when compared with Muskrat Falls. The cost to ratepayers, again, always coming back to the cost to the ratepayers, will be greater than the refurbishment of Holyrood and a cost higher than Muskrat Falls. The power generation demand on the island is so small, and I think if you look at it, and it'll correct me if I'm wrong on this, because some of these numbers don't mean a whole lot to me, but I think in the Ziff report they refer to the fact that we would need like 0.12 to 0.59% of natural gas developed, which is what, 1/100? Is that?
Minuscule.
Yeah, so Ed he can talk about that further. But so then you've got to invest the significant investment in offshore infrastructure, facilities, wells, and a pipeline, plus the associated operating costs, so that you cannot produce a return on the capital required for the oil and gas companies. We are interested in developing natural gas. It's outlined in our energy plan, and it will happen when the time is right. However, our energy plan also states that actions to facilitate natural gas development in our offshore will not interfere with normal competitive business practices. Our goal is to ensure offshore development occurs in a market-oriented environment that is competitive with other jurisdictions. In the second scenario, being the LNG, or liquefied natural gas, the first thing to note is that it may have a lower capital cost, but the operating cost is high. Again, we're dealing with fossil fuels. The low and variable volume of gas required to produce power at Holyrood would be a challenging economic barrier to securing long-term, firm LNG supply in world markets. For example, the Henry Hub price, which is very low, once that gas goes on a tanker, it's going to whoever will pay the most money. I mean, that's the way the markets work, and my understanding is that the gas in Europe will sell for $9 or more, and the Asian markets can be $12 to $15. So where can you get your best price? So from a utility perspective, you're going to need a firm contract, and that firm contract will have to be obtained in order to have security supply. It's going to have to be at world prices. So that's not a good or viable option. However, the issues raised, as I've indicated, are valid. Ziff states that even if low-cost gas could be sourced, however, it would still have to be indexed or still have to be available at an oil-indexed price in the range of 80 to 90% Brent crude. And I think you'll see a chart there today where we use both 80% Brent and 90% Brent in terms of the CPW of gas. So full cycle LNG gas cost will likely be similar or in excess of the current oil-fired generating at Holyrood, and certainly higher than the proposed Muskrat Falls project. A CPW analysis was performed or prepared, which compares alternatives so that we have this apples-to-apples comparison. And liquefied natural gas would be $2 to $2.7 billion more than Muskrat Falls, and a pipeline standalone facility, which I think is the scenario put forward by Dr. Bruno, would be approximately $4 billion more expensive. So they're all more expensive than the isolated option also. So in terms of this CPW, Muskrat Falls would cost $8.4 billion. Isolated island, $10.8. LNG would range based on 80 to 90% Brent crude at $10.7 to $11.1. The Dr. Bruno proposal of the FPSO pipeline would be $12.8 billion, and a standalone pipeline with a GBS-type facility would be $15 billion. Natural gas development would also keep the province tied to volatile fuel prices. And anyone who's been following what's happened with the natural gas in the world in the last number of years can see the volatility. And what we're told lately is that shale gas development is slowing down in the United States because shale oil is being developed more. So the price has gone up, I think, from $2.15 to $3.70 in a period of a couple of months. So we are simply replacing one fossil fuel with another. Even if natural gas was a cost-effective, economically viable option, which it is not, it does nothing to provide power for potential mining developments in Labrador, whereas the development of Muskrat Falls meets the island's energy needs and allows for additional energy for Labrador mining and industrial development, or industrial development in the island for that matter. There has been extensive analysis done on the development of Muskrat Falls, as you can see this week. We've looked at the alternative energy options. Nalcor did all this at decision Gate 2. However, the critics said that's not enough. So we've responded with the reports. We've outlined the reports, and now it's there for everyone to examine. We're releasing them to the public. Well, what the analysis clearly shows is that Nalcor's decision Gate 2 screening was correct, and that Muskrat Falls is the best and least cost option available to meet Newfoundland and Labrador's future energy needs. At this time, based on the report of Ziff Energy into the LNG and Grand Banks pipeline options, we conclude that natural gas development is not a cost-effective, economically viable option to address the province's future energy needs, especially when we are considering how to meet this need for the short term. Thank you very much. Ed.
Well, thank you, Minister, and good afternoon. Nalcor's initial screening process at Decision Gate 2 in November of 2010 employed 5 key principles: security of supply and reliability, cost to ratepayers, environmental considerations, risk and uncertainty, and number 5, financial viability of non-regulated elements. As I've noted many times previously, the initial screening is important as it enables Nalcor Energy to concentrate further consideration on only the technologies and alternatives that offer the highest potential to ensure effective expenditure of ratepayers' funds. There are 2 models for natural gas which Nalcor examined. One was to bring gas via pipeline from offshore Newfoundland, and the second was to import liquefied natural gas, or LNG, via tanker. Nalcor examined the natural gas from the offshore as part of its DG2 analysis and concluded that, to date, no proposal for natural gas development, either export or landing, has been submitted by the offshore operators despite years of technical and economic study. Furthermore, Nalcor evaluated a range of natural gas configurations for generation, including modification of the Holyrood plant to burn natural gas and replacement of the Holyrood plant with a new efficiency combined cycle gas turbine. And further concluded, because of the relatively low volume of gas required and the high infrastructure costs associated with such a development, bringing natural gas from the Newfoundland and Labrador offshore is not an economically viable alternative. Nalcor also examined LNG as an alternative and concluded there was no clear advantage for ratepayers on a similar basis. And that basis was the higher cost of infrastructure coupled with the fuel costs and that fuel that we would have to pay on the world stage. This was confirmed by Ziff's analysis as well. In closing, our extensive analysis of supply alternatives show that the interconnected island option, specifically Muskrat Falls and the Labrador Island Link, is a less expensive option for consumers. Thank you.